Hello everyone. Good morning. Today we are here to discuss on chapter 2 of class 12 accountancy, that is fundamentals of accounting for partnership, and the name of the chapter is accounting for partnership fundamentals. See, basically we have started with this chapter in our last video, and in that lesson we have learnt about the basic meaning of partnership, the features of partnership, and after that we have studied about partnership deed, which is a very important element for the partnership business. Next we have studied about what are the contents of the partnership deed. Next we have studied that what may happen if there is no deed. See, basically in class 11, while studying in class 11, we have studied that registration of partnership firm is not necessary. It is not mandatory, but if the partnership firms goes for the registration, there are certain benefits. If there is no registration availed by the partnership firm, then there are some consequences for the non-registration. So as there is no requirement of registration of partnership, not necessarily that each and every partnership firm will have a partnership agreement or partnership deed. In that cases, how the partnership business will conduct its activities or whatever the accounting treatments will be there, we have studied in our last lesson. Then what we will study in our today's lesson, basically today's lesson depends on the accounting treatment of the partnership firm. So basically, starting before the accounting treatment of the partnership firm, we should know what are the accounts that is required to be prepared by a partnership firm. See, in class 11 you have studied about final accounts of sole proprietorship. What you have studied over there? You have studied how to prepare trading account, and from trading account you have calculated gross profit. Then you have studied how to prepare profit and loss account. The gross profit calculated from the trading account is carried forward to the profit and loss account, and from the gross profit that is carried forward in the profit and loss account, some expenses was deducted. These expenses are known as operating expense. So we can say that whatever is deducted from the gross profit so that net profit can be calculated are known as charge against profit. See, before preparing the accounts of a partnership firm, some terms should be explained. So first term that we need to explain is charge against profit. Now what are these charge against profit basically? Basically these are the expenses that are deducted from the gross profit so that net profit of the firm can be calculated. So net profit is calculated with the help of profit and loss account in a similar way that we have done in class 11. And the expenses, again I am repeating, and the expenses that are deducted from gross profit is known as charge against profit. Now see, as a characteristics of partnership, you have studied that two or more than two persons basically conduct the partnership business. Now if there are two or more than two persons, the profit needs to be divided. The profit needs to be divided. How will the profit be divided? That division of the profit into the partners are known as appropriation of profit. Appropriation of profit. That means division of the net profit into partners. In sole proprietorship firm, what you have done, you have calculated the net profit directly. You have taken the net profit and added it with the capital amount in the balance sheet. But in case of partnership firm, we are not going to do it. What we are going to do? First, we will divide the amount of net profit among the partners. Then we will calculate the capital of the partner. So again, what we will do? Number 3, we will calculate capital of partners. What is the amount invested by the partner? What is the amount of profit earned by the partner? What are the amount of drawings that has been withdrawn from the business by a partner, etc., etc. And finally we will calculate the capital. This capital is known as closing capital. Since it is almost similar as you have done in class 11 accountancy, it is almost the same. That means in class 11 accountancy balance sheet with opening capital, you have added the net profit. With that, you have added the interest on capital. From that, you have deducted drawings. From that, you have deducted interest on drawings. Finally, you have achieved the closing capital. In the same way, we will also calculate the capital of partners, and this capital is known as closing capital. Clear? So now what we can say, that the main purpose of partnership firm is to distribute the profit among the partners and to calculate the closing capital, and then finally prepare the balance sheet of the partnership firm. Now there may be a query from your side. That means for a partnership firm, students have to prepare trading account, students have to prepare the profit and loss account, then they have to divide the profit among the partners, then they have to calculate the closing capital, and finally the balance sheet. If this is your query, then my answer is no, because trading account is prepared for a sole proprietorship form of business, and from that gross profit is received, which is in turn carried forward in profit and loss account. Finally, all the charge against profits are deducted, and then what we can study is that the net profit will be carried forward to the PL appropriation accounts for appropriation of profit. Now, to mention one thing, in our last lesson we have studied about interest on loan. Basically, I want to maintain that whatever the partnership accounts are prepared, interest on loan is a charge against profit. This interest on loan is given by the business firm, by the partnership firm to the partner. The question arises why? Because if the business firm or the partnership firm goes for a loan from the outsiders, they have to pay an interest. Similarly, interest has to be paid to the partners also for providing loan other than the amount of capital. That is the reason interest on loan will be treated as a charge against loan. Now, at times in your questions, you may get that net profit is given and adjustment is given. What is the adjustment? Partners have their own personal property which the business firm or the partnership firm uses for business activity, and rent is paid. That means this is not included in the net profit. So before transferring the net profit for appropriation, from that net profit, rent amount given to the partners has to be deducted, and interest on loan amount that is given to the partners has to be deducted, and then appropriation of profit can be done. Now for appropriation of profit, account are prepared. What account is prepared? Let's see. For appropriation of profit, number one account is PL appropriation account. Okay, and for this one, what is another account is prepared? That we can say number 2 is partners capital account. Now, this partner capital account can be prepared in two ways. Fixed capital, and number 1 is fixed capital and number 2 is fluctuating capital. So we will start with the accounts one by one, and in our forwarding towards the accounts, first we will start with PL appropriation account.
See, already discussed that PL appropriation account helps in division of the net profit and distributing them to the partners. It can be said that it is the extension of profit and loss account, and in this account there are certain adjustments. These adjustments are interest on capital, interest on drawings, salary to partners or commissions to partners, transfer to reserve, and then finally distribution of profit to the partners' capital. So, the main purpose of profit and loss appropriation account is to calculate and distribute the divisible profit, and this divisible profit is not considered as expenditure under the tax and audit rules.
Now let's follow the journal entries on the basis of which the PL appropriation account is prepared. See, already I have discussed that the net profit is being further carried forward to profit and loss appropriation account. So profit being a credit balance will be closed and the PL appropriation account will be opened for transferring the net profit, and hence the journal entry will be profit and loss account debit to profit and loss appropriation account. Net profit is the main source of profit that is achieved from the profit and loss appropriation account, and from this certain adjustments are made regarding interest on capital, salaries, commission, etc., etc. So starting with interest on capital, we can say that it is a liability made by the business firm, and hence the journal entry will be profit and loss appropriation account debit to interest on capital. See, when a liability is increased, definitely at the consequences there will be a decrease in the asset, and profit can be treated as an asset, so there will be decrease in profit and loss appropriation account. In class 11, starting with accountancy, you have already studied that business is a separate entity and the owners are separate individuals. So we can say that as this is a liability, that is interest on capital is a liability for the business, at the same time it is an asset for the partner. Thus, this interest on capital will increase the amount of partner's capital, and we can say the journal entry will be interest on capital account debit to partner's capital. The next adjustment that we have is interest for drawings. Drawings means withdrawn by the proprietor from the business for personal use. And we can say that as the partners are withdrawing the money, they have to pay some interest to the business. So in this case, interest on drawings is an asset to the business, and thus the journal entry will be interest on drawings account debit to PL appropriation account. Now adjusting the interest on drawings in the partner's capital, we can say that yes, as the partners will be paying interest on drawings, there will be a reduction in the capital, and the journal entry will be partners capital account debit to interest on drawings account. Next, we can have partner's salary. It is an income for the partner and a liability for the business. Thus, payment of salary being a liability reduces the net profit, which is a income for the business organization, and hence we can say the journal entry will be profit and loss appropriation account debit to partner's salary or partner's commission account. Next, for adjustment in the capital, this will increase the amount of capital, and hence the journal entry will be partner's salary or commission account debit to partner's capital account. Now see, there can be one more adjustment, that is transfer to general reserve. Yes, this can be done for the savings purpose, which will give future benefit, and yes, reserve is a liability, and at a time liability increases and there must be a decrease in the profit, so the journal entry will be profit and loss appropriation account debit to general reserve. So here lies the format of profit and loss appropriation account, and finally it follows the nominal account, where credit side records all the income for the business firm, mind it, for the business firm, not for the partners, and the debit side records all the expenses for the business firm. See, at the debit side, at first you get to profit and loss account. That is a rare case if there is a net loss calculated from the profit and loss account, and in general case always there will be a net profit calculated from profit and loss account. So max cases you will get that PL account will be debited and profit and loss account will be credited, and in rare cases you will get that PL appropriation account will be debited and profit and loss account will be credited. And now, as interest on drawing is an income, credit side interest on capital expense, salary, commission expense. Transfer to reserve is not an expenses but increases the liability, so also it will be recorded in the debit side as it has an effect on profit and loss distribution, and finally the remaining balance will be distributed in the profit sharing ratio.